In an ideal world, wouldn't it be wonderful to have money flowing in regularly without lifting a finger? That's the allure of passive income, a concept that resonates deeply with seasoned investors and beginners alike. For many, passive income represents financial freedom and the ability to pursue passions without the constant worry of meeting monthly expenses. While there are numerous avenues to generate passive income, mutual funds have emerged as a popular choice, particularly those designed for monthly income distribution. Before we delve into specific funds, let's demystify mutual funds for those new to the investment world. Imagine a basket containing a collection of stocks or bonds. When you invest in a mutual fund, you're essentially buying a share of this basket, which is managed by professional fund managers. These experts pool money from multiple investors and strategically invest in a diversified portfolio of assets, aiming to achieve specific investment objectives. As the name suggests, monthly income funds prioritize generating regular income for investors. These funds primarily invest in debt instruments like bonds, which are considered less risky compared to stocks. Bonds act as loans to governments or corporations, and in return, the issuer pays the lender, bondholder, a fixed interest payment, known as a coupon payment, typically on a semi-annual basis. Monthly income funds aim to distribute these coupon payments as dividends to their investors, creating a stream of passive income. HDFC Monthly Income Plan stands out as a popular choice among investors seeking regular income. This fund predominantly invests in a mix of debt and money market instruments, aiming to provide consistent returns with a relatively lower risk profile compared to equity-oriented funds. While past performance doesn't guarantee future returns, HDFC Monthly Income Plan has a track record of delivering steady dividends, making it an attractive option for conservative investors. Section 5. ICCI Prudential Regular Savings Fund, another strong contender. ICCI Prudential Regular Savings Fund is another prominent player in the monthly income fund category. This fund follows a similar investment strategy, focusing on debt instruments and money market securities. It aims to provide investors with a regular income stream while keeping the risk relatively low. Like HDFC Monthly Income Plan, ICICI Prudential Regular Savings Fund boasts a commendable track record, but it's crucial to remember that past performance should not be the sole basis for investment decisions. Section 6. Navigating risk, a key consideration. One of the golden rules of investing is understanding that every investment carries an inherent level of risk. Risk, in simple terms, refers to the possibility of your investments losing value. Mutual funds are no exception. Monthly income funds, while generally considered less risky than equity funds, are still subject to market fluctuations. Factors like interest rate changes and inflation can impact the value of the underlying bonds, potentially affecting the fund's NAV and dividend payouts. Section 7. Aligning funds with your investment goals. Choosing the right mutual funds is not a one-size-fits-all endeavor. Your investment goals play a pivotal role in determining which funds align best with your financial aspirations. Are you investing for a short-term goal like buying a car? Or are you looking for long-term wealth creation for retirement? Defining your investment horizon, the time frame you plan to stay invested, is crucial. Generally, longer investment horizons allow you to ride out market volatility and potentially benefit from compounding returns. Section 8. Beyond dividends, evaluating fund performance. While dividends are a major draw for monthly income funds, they shouldn't be the sole metric for evaluating a fund's performance. It's essential to look beyond dividends and assess other crucial factors like expense ratio, historical returns, and the fund manager's track record. The expense ratio represents the annual fee charged by the fund house for managing your investment. Lower expense ratios translate to more of your money working for you, so it's a factor worth considering. Section 9. Diversification, the cornerstone of a robust portfolio. Imagine putting all your eggs in one basket. If that basket were to fall, you'd lose everything. The same principle applies to investing. Putting all your money into a single mutual fund, even a seemingly stable one, can expose you to unnecessary risk. This is where diversification comes into play. Diversification involves spreading your investments across different asset classes, sectors, and geographies to mitigate risk. Section 10. Seeking expert advice, when and why it matters. Navigating the world of mutual funds can be overwhelming, especially for novice investors. Seeking advice from a qualified financial advisor can provide invaluable insights tailored to your specific financial situation. A financial advisor can help you define your investment goals, assess your risk tolerance, and recommend a diversified portfolio of mutual funds that aligns with your financial aspirations. Section 11. Conclusion. Paving the way to financial security. In conclusion, mutual funds, particularly those designed for monthly income, can be valuable tools in your pursuit of financial stability and passive income generation. By understanding the fundamentals of mutual funds, assessing your risk tolerance, setting clear investment goals, and embracing the power of diversification, you can pave the way for a more secure financial future.